So we'll now just review the Basel III regulations and understand the provisions in more detail. So essentially, as we studied, Basel III made Tier 1 requirements more stricter, and we'll see them in more detail. It added a capital conservation buffer that firms need to build upon in good times and which could be drawn in the case of stress. So for 2013, please recall Basel III said that total risk capital should be 8%, of which Tier 1 needs to be 4.5%, and of the Tier 1, core Tier 1 needs to be 3.5%. The ratios of Tier 1 and core Tier 1 keep going up until 2018-2019, and the capital conservation buffer also keeps increasing. So the capital requirements go up significantly as the years pass in Basel III. So Basel III essentially makes the capital requirements more stringent as compared to Basel II. It puts additional restrictions on what can qualify as Tier 1, and it completely abolishes Tier 3 capital as we studied, which Basel II could use for market risk charge. The goal of the committee now is to promote a more resilient banking sector in the wake of the recent financial and economic crisis. So the committee found that many factors contributed to the crisis: excessive on and off balance sheet leverage, erosion of capital, and insufficient liquidity. Systemic risk further resulted from the interconnectedness of the financial institutions and the globalization. So eventually what we saw in 2007-2008 was that participants lost confidence in the banking system and the liquidity contracted worldwide. So this is the kind of situation that we now want to avoid, and which is what Basel III intends to do through the various regulations. So Basel III raises capital standards both in terms of quality and quantity, improves the transparency and consistency of the capital, strengthens the risk coverage of the capital framework, requires a leverage ratio to further supplement the capital requirements, and promotes counter-cyclical buffers to offset pro-cyclical amplification of financial shocks, as we'll see in the coming slides. Essentially, in good times, we are required to save so that in bad times, we don't get into such a deep mess. Institutes policies that address systemic risk and the interconnectedness of the financial sector, and finally proposes to institute a global liquidity standard. In Basel II, we studied that the definition of Tier 1 capital included common stock, retained earnings, disclosed reserves, non-cumulative preferred stock, etc. In Basel III, the definition of common equity Tier 1 capital, which needs to be a big proportion or a big portion of the total Tier 1, now consists only of common stock and retained earnings. So that's the common equity Tier 1. It is only common stock and your bank's retained earnings. Additional Tier 1 will be these subordinated, fully discretionary instruments like perpetual bonds, where there is no fixed date of maturity and there is no incentive to maturity. So the non-cumulative preferred stock that was a part of Tier 1 is now additional Tier 1. Tier 2 will consist of subordinated instruments, which is the same as before, with minimum maturities of 5 years and no additional incentives on redemption. So holders of these bonds will actually hold for 5 years, and holders in the additional Tier 1 have no incentive to redeem. They will likely hold till perpetuity. Regulatory adjustments may further be made to any of these calculations, and as we studied earlier also, goodwill and intangible assets would be deducted from the common equity Tier 1 capital, as we also did in the example earlier. Tier 3 capital, as we discussed, will be phased out under the new capital or the new Basel standards. So the minimum capital standards that will be phased in between January 2013 to January 2015 as per Basel III will have common equity Tier 1 as at least 4.5% of the risk-weighted assets. Total Tier 1, that is the common equity Tier 1 plus the additional Tier 1, that is these non-redeemable, non-cumulative preferred stock, etc., should total 6% of the risk-weighted assets. Total capital, that is tier 1 plus tier 2, must at least be 8% of the risk weighted assets. The transparency of the capital will also improve, as banks will now be required to disclose a full reconciliation of how these capital elements come and how they are being used to meet the capital requirements. You'll also now be required to provide an explanation of the calculations of the various capital ratios. A capital conservation buffer or a counter-cyclical buffer will further be required as a cushion against loss in times of stress. So this will be an additional 2.5% of common equity tier 1 capital that will need to be maintained by banks, such that in bad times they have further buffer and they can draw down on this buffer. Banks that do not meet the capital conservation buffer or this counter-cyclical buffer will have additional constraints on the distribution of capital, stock repurchases, bonuses, etc. The committee further believes that all on and off balance sheet risks must be captured. So the counterparty credit risk calculations that we did earlier will be further revised and will become effective from January 2013. Banks that engage in large derivative sales and trading businesses will be required to hold more capital. There's an incremental risk charge, as we studied, that Basel III brings in. Basel III brings in additional reforms to address counterparty credit risk, credit value adjustments, and wrong way risks. Please recall, wrong way risks are risks wherein when we gain or the bank gain, the situation of the counterparty deteriorates. Not only does he have a loss on my position because I have gained, his overall position is also deteriorating. Right way risks are risks where when we gain, the counterparty may have a loss on my transaction, but overall he is also gaining, or his business position is also becoming better. So further adjustments for wrong way risks need to be now done and included. Risk weightings will increase for systematically important intermediaries. A 1.25 multiplier is what will be applied to the existing Basel II correlation assumptions. So bigger institutions and bigger intermediaries may need to keep more capital. The effective expected positive exposure, that is the possible credit exposure we may have in the future, should be estimated using current data and a stress calibration as well. The greater of the two calculations is applied to the capital requirement. If the bank is using internal models for estimating credit value adjustments, then the bank must get an approval before it can use an internal model. If the bank does not have a sophisticated enough system, then a standardized model is being prescribed by the committee. We understood remargining in credit risk, and we said that within the margin period the position can deteriorate further. So the assumptions for the margin periods have further been increased with Basel III, that is in the time that a capital call is made or a collateral call is made and the time that we get the collateral actually, that assumption has been further increased, and hence a further capital buffer may be needed when modeling the exposure at default. Once again, banks are required to use stress tests and scenario analysis to identify risk factors that are positively correlated with the creditworthiness of the counterparties. So when we gain, if the creditworthiness of the counterparty becomes better, that means it's a right way risk. When we gain, the creditworthiness of the counterparty deteriorates, would be a wrong way risk, and we should further keep capital or protect ourselves from wrong way risks that we have taken. Backtesting of the models that are used to calculate counterparty credit risk should be regularly done, and all credit counterparty risk review should happen at least once a year. External credit agencies or credit rating agencies will provide much greater data with much greater transparency than the Basel II framework. The same criteria about the objectivity, independence, resources, and credibility of the external rating agencies is maintained. Banks cannot cherry pick their rating agency, so they cannot have one external credit rating agency for risk management and another for capital purposes. So they have to use the same credit rating agency for all purposes that they may need. So the broad criteria for calculating the risk charge remains the same as in Basel II. However, as we studied, Basel III just has recommendations that makes these calculations more stringent and increases the capital requirements in most cases. So I don't expect many numerical questions from the Basel III recommendations. However, please go through and try to remember. In case a question comes with 4 choices, you should normally be able to get it if you remember even partially these points. So the Basel Committee has now introduced a non-risk based leverage ratio that will act as a supplementary measure to the risk-based capital standards. So the objective now is to constrain the buildup of leverage in the banking sector and to provide a simple backstop measure of leverage that supplements and reinforces risk-based capital standards. So the leverage ratio is intended to be 3%, which is where it should be by January 1, 2018. So the leverage ratio is defined as the tier 1 capital to on and off balance sheet items and exposures. So the way the leverage ratio will be calculated would be the tier 1 capital divided by the total on and off balance sheet items. So it will not be the risk weighted assets. The other requirements of core tier 1 8% total capital was on risk weighted assets. This leverage ratio would ensure that banks have 3% of the total on and off balance sheet exposures as tier 1 capital. Idea is just to check that the debt to equity doesn't go out of whack, or if this ratio comes below 3%, then the bank would be required to either reduce its exposure or bump up its tier 1 capital. As we studied, banks will be subject to a counter-cyclical buffer if the authorities deem necessary. So this buffer is intended to protect the sector by ensuring that capital requirements take into account macro factors. Pro-cyclical amplification is the cycle that ensues when a downturn leads to losses in the financial sector, which spreads to the real economy and then again back to the financial sector. So losses in the financial sector make availability of debt and credit and funding less easy, which in turn implies that businesses cannot start up as easily and GDP growth also slows down, and then it further hurts the banking sector. The counter-cyclical buffers are intended to dampen the effect of this pro-cyclical amplification and will only be implemented if credit growth is excessive or some other system-wide risk is evident. So if credit growth is very high, so essentially we're seeing that times are good, everybody is borrowing, then we may be required to keep certain additional buffer so as to ensure that if a system-wide event happens or a downturn happens, we have some additional capital with us to buffer against this loss and avoid the pro-cyclical amplification. Finally, capital surcharges, contingent capital, bail-in debt, etc. have also been proposed as measures to manage systemic risk. The interconnectedness of institutions contributed to the financial meltdown. So the idea now will be to mitigate system-wide risk, and hence the committee also plans to introduce an internationally coordinated global liquidity standard. So this standard is intended to improve the management of liquidity in institutions across the globe. This will include a liquidity coverage ratio, a net stable funding ratio, and monitoring metrics, as we'll see in the coming slides. So the Basel Committee on Banking Supervision has instituted two new complementary liquidity requirements. First is the net stable funding ratio, that is the amount of stable funding to the total cash outflows, as we saw earlier, should be greater than 100%. The outflows here are also referred to as the stable funding requirement. So the stable funding that the bank has upon the stable funding requirement should be greater than 100%. And the liquidity coverage ratio, that is the second measure, is defined as the stock of high quality liquid assets to the total net cash outflows over the next 30 calendar years. So this ratio should also be greater than 100%. That is the ratio of high quality liquid assets to the net outflows over the next 30 calendar years. The idea is to at least improve the bank's ability to withstand a liquidity shock for the next 30 days. High quality liquid assets are defined as having high credit standing of the issuer and low market risk, certain valuation, that is these assets are easy to value and have more liquidity, low correlation with risky assets, listed on a recognized exchange, they have active and sizable markets, committed market makers who will provide liquidity in these assets, diverse buyers and sellers, and in a general flight to quality, market has moved to these kind of assets. So market moves to high quality liquid assets in times of stress. So these would be those assets. So the ratio of these high quality liquid assets to the 30-day net cash outflow requirement should at least be greater than 100%. Level 1 high quality liquid assets include cash, reserves, 0% risk weighted marketable securities, and some non-zero risk weighted securities of sovereigns and central banks. Level 2 assets are of lower quality, that is, they have higher risk weights in the Basel II framework, and they may comprise no more than 40% of the overall high quality stock. Some additional classes of assets may also be recognized as level 2 on the discretion of the supervisors. So total level 1 plus level 2 upon the 30-day cash outflow should be greater than 30%, of which level 2 cannot be more than 40% of the total. The definition of net cash outflows includes runoffs on retail deposits, losses of unsecured wholesale funding, losses of secured short-term funding, outflows that result from downgrades of debt, so on and so forth. So all these outflows the bank would be required to calculate what may happen in stress times, and then we need to ensure that we have high quality liquid assets to meet these requirements if they come due. So if retailers or if depositors suddenly decide to withdraw their money, and similar instances of loss of funding, at least for the next 30 days we should be able to withstand such shocks. The committee has further instituted various metrics that will help in informational gathering and assessment of bank liquidity, so that supervisors can more consistently monitor liquidity at both the bank and system-wide levels. So there are 5 metrics which include the contractual maturity mismatch, concentration of funding, available unencumbered assets, liquidity coverage ratio by a significant currency, and market-related monitoring tools. All of these 5 points we'll see in more detail in the coming slide. So the contractual maturity mismatch identifies the amount of liquidity a bank may need to raise in a specific time band, assuming all outflows occur at the earliest possible date. So a retail deposit, for instance, has no contractual maturity, so he can withdraw at any point in time. So the contractual maturity mismatch will be calculated assuming all retail deposits or a big percentage of those are withdrawn. Similarly, other liabilities that have a short-term maturity are also withdrawn at their earliest possible maturity. So if all liabilities are withdrawn at their contractual maturity, what will be the strain on the liquidity of a bank, or how much money it will need to provide to all these liabilities? Similarly, the concentration of funding attempts to identify those significant sources of wholesale funding which, if withdrawn, could trigger liquidity problems for a bank. So if a big part of my deposits comes from one source or one mutual fund, then if that mutual fund sees trouble, or if he withdraws his funds, then I may need to sell my assets to meet that redemption. The available unencumbered assets provides data regarding the quantity, key characteristics, and the currency denomination and location of a bank's unencumbered assets. The more the unencumbered assets, the lesser would be the liquidity problems. Once again, the liquidity coverage ratio by significant currency is calculated as the high quality liquid assets in each significant currency divided by the total net cash outflows in that currency over the next 30 calendar days. So supervisors and banks can use high frequency market data with little or no time lag to warn of potential liquidity problems in the bank. So if capital calls keep coming or funding keeps getting withdrawn consecutively over periods, then it may indicate potential problems or liquidity problems in the bank. Supervisors should monitor market-wide information, financial sector information, and bank-specific information to judge whether the liquidity coverage is sufficient or not. The last reading compares the Basel regulations for banking with the solvency requirements or the Solvency II regulations for the insurance industry. Please note, the regulators need to be very careful in the insurance sector also, as if mishaps happen more than expected, then the insurance company may also go bankrupt. So the Solvency II requirements try to ensure that insurance companies have sufficient capital for the liabilities that they have written or for the insurance that they have sold. So both Basel II, 3 and Solvency II are modeled on a 3-pillar structure. That is, pillar 1, that is the quantitative requirements regarding the required capital and risk measurement. Pillar 2 relating to the qualitative conditions of risk management, the terms of supervisory review, and the institution's assessment of risk and solvency. And pillar 3 regarding the requirements of disclosure. Basel II, however, places a stronger emphasis on the stability of the financial system because systemic risk is more evident in the banking industry as compared to insurance, whereas Solvency II focuses on individual policyholders and individual insurance companies. Liquidity of the banking system is paramount. A bank run can affect the whole banking system. So if all depositors of one bank decide to withdraw their money because they're concerned about the bank, then that bank may go bankrupt, and the bank is interconnected with other banks because the bank may have taken loans from other banks, and hence it may turn into a systemic crisis if there is a run on the assets of any one bank. The insurance industry in Solvency II focuses more on the risk of isolated insurer bankruptcy. So in the insurance industry, Solvency II requirements use a two-level approach. First is the solvency capital requirements. This is the target capital intended to handle unexpected losses and ensure a low one-year default probability. And along with the solvency requirement, there will be a minimum capital requirement. So this is the level below which, if the capital goes, the regulatory authority will invoke the insurance companies or rather revoke the insurance company's license. Now, depending on how big the insurance company is, how many different businesses it has, general insurance, life insurance, health insurance, the kind of products in each of these business lines, etc. Solvency II will allow for 3 levels of diversification benefits in the risk calculation. So if you have your business spread along many lines and along many asset classes, then the risk will be lower because of three levels of diversification. So first is within the specific class of risk and the specific line of business. For example, disability risk within the healthcare department or the health insurance department. So if I'm insuring many different people, then the disability risk reduces, or the more the number of people I insure, the disability risk reduces because of the diversification benefit, because my risk is now diversified amongst many people. The second diversification happens within the specific class of risk across specific lines of business. So the disability risk may be there in the health insurance vertical. Disability risk may also cause outgoes in the life insurance part of the business. And if we have other business lines, then again, the specific class of risk would be assumed to be diversified across business lines also if we are taking it in different lines of the life insurance company or the insurance company. Similarly, diversification benefit will come across specific classes of risk, for example, mortality risk, disability risk, within a definite legal entity. So when we aggregate the risk of all different business lines of the insurance company, then again there is a diversification benefit happening. That is, as when one may be in a loss, the other may or may not be in as much of a loss. And finally, diversification benefit across definite classes of risk across legal entities that a holding company or a holding insurance company may have. So Solvency II, that is for insurance companies, allows for three levels of diversification benefits. Do not need to know the great in-depth details, so even if you understood it broadly, it will serve the purpose. While on the other hand, Basel considers only level 1 diversification, that is, it does not consider possible diversification effects amongst the three classes of risk, that is, credit risk, operational risk, and market risk. So within market risk, diversification may be considered in the internal model approach and other approaches. Within operational risk also, diversification may be considered. However, amongst these three classes of risk, the diversification is not considered. We have to keep a capital charge separately for all the three classes as against Solvency II. Solvency II does consider diversification effects amongst risk classes. However, the risks that insurance companies face would be different from the risks that a bank would face. So Basel primarily looks at asset risks, that is, the loans may default or the value of assets may decline because of market risk, etc. While Solvency II will take into account all risks, that is, the risk of their assets declining in value for an insurance company, as well as the risks of liabilities becoming more than what we accounted for, that is, more disabilities happened, more deaths happened, etc. Both Basel and Solvency II use WAR. So Basel uses it to cover unexpected losses, while Solvency II contains requirements intended to ensure a 1-year solvency for the insurance company. Basel II is retrospective, while Solvency II is prospective. With Basel II, as we see, there is a standard approach generally and an advanced approach. So there's 2 levels of sophistication. In contrast, Solvency II provides a choice of 5 levels of sophistication. Basel II recognizes only level 1 diversification benefits. Diversification benefits across categories of risk is ignored, while Solvency II acknowledges all levels of diversification benefits. The valuation in Basel II is market based for the calculation of market risk and is accounting based for the calculation of credit risk, while Solvency II's valuation is based on the economic balance sheet and not the accounting balance sheet. Details of this you don't need to know. You should just understand the difference between Solvency II and Basel II. Both have qualitative requirements regarding risk management and supervisory review under Pillar 2. So both are analyzed based on principles, aims, scope of supervision, considered risks, internal risk management processes, general government requirements and organizational structure, additional requirements, and supervision. Both account for all material risks and focus on internal risk management process. Governance requirements for both banking and insurance dictate a clear, transparent organization with clear allocation of responsibilities. So these are some similarities between Basel II and Solvency II. Public disclosure requirements only apply at the management level under Basel II, but they will apply at all levels under Solvency II. So the disclosure needs to be more granular for Solvency II as compared to Basel II. For both banks and insurance companies, the composition and the amount and quality of own funds must be publicly disclosed. So this is the capital, the tier 1 capital and the risk capital that these institutions are keeping. Capital requirements must also be disclosed in both frameworks, but with varying levels of detail. So that was about comparing Basel II and Solvency II, another reading that has been introduced in the FRM Part 2 curriculum. So that was broadly about the Basel regulations. Please make sure you look at a few past exam questions and you practice some questions before you get lost in the details and in the theory. So try to keep it a little more exam focused and focus on the areas that have generally been tested more by the institute. So thanks a lot and see you next time.